What if I told you that by 2026, the entity managing your retirement fund will literally be spying on a Walmart parking lot from space?
Right.
Or like reading the shadow of an oil rig in Texas
Hmm.
and then instantly rewriting its own trading rules all the time it takes you to blink.
I mean, it sounds like science fiction, right? But it is exactly where the smart money is heading right now.
Yeah.
We're moving from a world where computers just execute our ideas to a world where they actually generate the ideas, test them, and then execute them before a human analyst has even finished their morning coffee.
It's wild. So welcome to this custom deep dive. Today we're looking at the literal rewiring of global money for you, the listener.
Mm-hmm.
We've got our hands on a really fascinating set of research drawn from a document titled Vloujeni Text.
Which is a great read, by the way.
Oh, absolutely. And it forecasts this intense reality of trading by the year 2026.
Sure.
So the mission for our deep dive today is to really unpack how the financial landscape is fundamentally shifting from, human intuition to adaptive machine intelligence.
Exactly.
It's an absolute technological arms race in the investment community.
Okay, let's unpack this because the sheer scale of the changes happening right now is just staggering.
It really is staggering. And to understand why this matters for you as an investor or even just someone participating in the economy, we first have to look at the baseline shift.
Right, like what's happening on the ground.
Yeah, these aren't just, new software updates being installed at hedge funds. This is a complete paradigm shift in how value and risk are calculated. The research we're looking at points out that by 2026, roughly 90% of private fund managers—
Wait, 90%?
90%. They are expected to use AI for investment research, portfolio optimization, and trading. We're moving into an era where the software itself is the absolute core engine of market decision-making.
Okay, right. But let's be clear here. They aren't just using the standard algorithms we've had for the last decade, right? Like a traditional deterministic algorithm is sort of like an incredibly fast train on a track.
That's a good way to put it. Yeah, like it can go hundreds of miles an hour, it processes data at lightning speed, but it can only go exactly where the rails have been laid down by a human programmer. It just says, if the stock drops to $50, sell 10,000 shares.
Exactly. It operates on known fixed rules. It's completely blind to anything outside its specific track.
Right.
But what we are talking about today is the shift toward adaptive systems using reinforcement learning. It's known as decision intelligence.
Decision intelligence. Which, that sounds a lot less like a train and a lot more like a self-driving all-terrain vehicle.
Yes.
Like it's actively learning the landscape as it drives. It doesn't just offer an insight to a human portfolio manager, it actually automatically adjusts its own trading parameters in real time.
Precisely.
But I have to play devil's advocate here for a second. If the AI is essentially taking the wheel and 90% of fund managers are using these self-driving vehicles, doesn't the advantage just evaporate? If we all have the same God mode view of the market, doesn't the baseline just shift?
That is the exact friction driving this whole arms race. What's fascinating here is that the advantage doesn't evaporate, it evolves.
Okay, how so?
Because these models are self-learning, it becomes a game of who can adapt the fastest. The firms that are stuck on those traditional train tracks, they're going to be completely outmaneuvered by adaptive models that literally learn to exploit rigid human behavior.
Oh, wow.
Yeah. If your algorithm always sells when the market drops 2%, an adaptive AI will notice that pattern, anticipate your automated sell-off, and position itself to profit from your panic.
That is brutal. So to win that arms race, to be the smartest self-driving vehicle on the road, you need unprecedented eyes and ears. You need to see the potholes before anyone else even knows they're there.
Exactly.
And that leads us directly into how this AI is being fed just massive complex data sets to find its edge. Because we aren't just talking about, reading quarterly earnings reports anymore.
So no, not at all.
Right. By the time an earnings report comes out, the market has already reacted. It's dead data.
Precisely. Traditional data is priced into the market the millisecond it hits the wire. So to find new sources of alpha—
which is just the industry term for excess return on an investment.
Right, exactly. To find that alpha, these AI models are aggressively harvesting alternative data. They are synthesizing the physical world into digital trading signals.
Okay, here's where it gets really interesting. When you look at the specific examples of alternative data being used in this source text, it sounds like a literal spy thriller.
It really does.
We are talking about utilizing satellite imagery for retail traffic forecasts. And the research shows this achieves up to 85% accuracy in earnings predictions, 85%.
Yeah, it's incredible.
They're also using web-scraped sentiment analysis to sharpen short-term forecasts by roughly 15%.
My
I mean, come on, are private investors really spying on mall parking lots from space to guess quarterly earnings?
I mean, it does sound like corporate espionage, but it is highly effective. And if we connect this to the bigger picture, it's not just taking a picture of one parking lot.
Right.
It's about combining that with a dozen other hidden variables. It's synthesizing millions of non-traditional data points that traditional spreadsheets just entirely miss.
Okay, let's trace a real-world scenario of how this actually executes. So imagine an AI model running a natural language processing, or NLP, protocol.
Right.
It's constantly scanning and translating local news sites globally. And suddenly, it notices this tiny, let's say 5% uptick in the phrase supply chain delays in local Chinese newspapers near a major shipping port.
Right. And a human analyst in New York wouldn't even see that local paper, let alone speak the language or notice a statistical anomaly in the vocabulary.
Exactly. So the AI sees this NLP anomaly. It immediately cross-references that with live satellite imagery of that specific port.
Mm-hmm.
It counts the shipping containers and realizes the truck bays are, I don't know, 30% emptier than usual.
Yeah.
Then it maps out exactly which tech companies rely on the specific microchips sitting in those delayed containers, and it shorts their stock, basically betting against them 3 weeks before the companies even realize they have a supply chain problem.
That is a perfect illustration. The AI synthesizes geopolitical NLP, physical satellite data, and market mechanics in seconds.
Seconds.
Yeah, a traditional spreadsheet simply cannot process that volume of chaos. By 2026, having an AI that can interpret the tone of corporate communications on a live earnings call,
Oh, wow.
while simultaneously checking weather patterns over wheat fields, that's just going to be a standard differentiator.
Okay, so the AI has harvested all this wildly diverse alternative data. But having the data is really only half the battle. Now it has to process it, make sense of it, and execute a trade faster than a competing AI.
Exactly.
Which forces us to look at the new mathematical frameworks that are completely dominating high-frequency trading, or HFT, because traditional statistical models are apparently hitting their absolute limits.
They really are, and it all comes down to how humans have traditionally forced machines to view time.
Time.
Yeah, time. Traditional financial models take discrete snapshots. They look at the market at 9:00 a.m. and then again at 9:01 a.m. They assume data arrives in neat, predictable, regular intervals.
Which it doesn't.
Right. The real market isn't neat, it's chaotic. Someone might buy 3 shares at 9.00 and then a million shares at 9:00 in 12 seconds.
So to handle that chaos, the architecture of the math is changing. Let's start with graph neural networks, or GNNs, which the research highlights as a major tool for mapping the market. Traders use these to model the market as a massive, complex web of relationships. I like to think of a GNN like an intricate spider web. If a fly hits one tiny corner of the web, the spider instantly feels the vibrations and knows exactly which threads are connected.
That's a great way to visualize it.
Yeah, so in the market, if a copper mine in Chile shuts down, the GNN doesn't just look at copper stocks. It knows exactly which bridge stocks linking entirely different industries will vibrate. It maps the center-wide impacts instantly.
Finding connections a human analyst would never dream of.
Right. But mapping the space is one thing. You mentioned time. The research points heavily to something called neural ODEs, ordinary differential equations.
Yes.
And it says they treat hidden states as continuous functions of time, which, I mean, that sounds like something out of an advanced physics seminar. Can you simplify that for us?
It is incredibly dense math, but let's break it down. If we connect this to the bigger picture, traditional models are like a flipbook of snapshots, right?
Okay.
Neural ODEs treat the market like a flowing river. They allow the AI to mathematically understand the continuous, irregular flow of time between trades.
So it's not just jumping from frame to frame.
Exactly. Instead of getting confused by irregularly sampled data like that massive gap between a tiny trade and a huge one seconds later, it understands the continuous curve of the action. And the research notes this approach is already achieving significant excess returns in simulated high-frequency environments.
Okay, so the ODEs handle the continuous flow of time. But what about the actual human behavior driving the trades? Because I'm looking at another term in our notes here, neural Hawk's processes.
Ah, yes.
And the context is that they're used to simulate the limit order book, the LOB.
Right. And the limit order book is essentially the live open ledger of all the buy and sell orders waiting to be executed at various prices. It's the literal heartbeat of market supply and demand.
Right, but the research says these Hawk's processes capture the granular dynamic relationships better than traditional stochastic models. Let's clear up the jargon there real quick. A stochastic model basically just relies on random probability, right? Like predicting a coin flip over time.
Exactly. Traditional stochastic models guess the probability of an order happening based on general randomness. But markets aren't purely random, are they? They are contagious.
Contagious. I like that.
Neural Hawk's processes are designed to understand momentum and contagion. If a massive sell order suddenly hits the limit order book, it triggers a panic.
Right. People freak out.
Exactly. Other people cancel their buy orders and start selling too. A Hawk's process mathematically models that exact cascade effect. It anticipates the avalanche before the snow has even finished falling.
Wow. So we have an AI that never sleeps. It's reading the news in 50 languages, processing satellite imagery, understanding the continuous flow of time, and predicting market avalanches.
Yep.
But here is the massive bottleneck. It's doing all of this inside a legacy banking system that still operates like it's 1995.
Oh, absolutely.
I mean, the bell rings at 4:00 p.m. in New York, the markets close, and the banks literally go to sleep for the weekend. How does the market physically evolve to keep up with an algorithm that refuses to wait for Monday morning?
Well, it forces the very structure of the assets themselves to change. An AI running continuous math cannot wait 3 business days for a standard stock trade to settle.
No way.
That latency is a death sentence for high-frequency trading. It demands instant execution, 247.
Which brings us to the tokenization of real-world assets, or RWAs. The forecast for 2026 highlights this as a transformative shift.
It's massive.
We're talking about taking traditional assets, corporate bonds, equities, physical real estate, or even gold, and turning them into digital tokens on a blockchain.
Precisely. And by tokenizing them, you remove the legacy clearinghouses entirely. These assets enter decentralized global markets that literally never close. The AI models we've been discussing are incredibly adept at finding arbitrage opportunities in these tokenized markets.
Let's define arbitrage really quickly for anyone who isn't, living and breathing finance. That's essentially finding a tiny price discrepancy across different markets.
Right.
Like buying a tokenized bond for 99 cents in London and instantly selling it for $1 in Tokyo.
Exactly. But doing it millions of times a second. And to actually move the capital around to capture those tiny price differences, the AI needs a reliable currency that moves at the speed of light.
Right. It can't wait for a bank transfer.
No. That is why the research notes that stablecoins are graduating from being just experimental crypto projects to becoming the core institutional plumbing.
They allow 247 real-time value transfers.
Right. It changes an algorithm's capital efficiency entirely. It's not leaving millions of dollars tied up in a pending wire transfer. It's moving digital dollars instantly, deploying capital exactly where the math dictates. The millisecond it spots an opportunity.
So what does this all mean? You have a global market running 24/7 on tokenized rails, driven by self-learning algorithms that are constantly pulling in alternative data and rewriting their own rules.
Yeah.
From a regulatory standpoint, that sounds like an absolute nightmare. I mean, if an AI is constantly learning and changing its own parameters, how on earth do you explain that black box to a European government regulator?
This raises such an important question, and it is arguably the biggest friction point of 2026. The technology wants to run completely free, but the law is pulling the leash back hard.
Yeah, nice.
You cannot just tell a regulator, well, we made this billion-dollar trade because the computer told us to.
Right.
That's why transparency and explainable AI, or XAI, are becoming absolutely mandatory.
The research specifically points to the EU AI Act, which classifies certain algorithmic trading systems as high risk.
Yes, the regulators are demanding a rigorous paper trail. If your fund executes a massive short position against a tech company, the regulators want to know exactly why.
Like, what did the AI see?
Exactly. Did your AI make this trade based on public sentiment, or did it somehow scrape and ingest material non-public information?
Did it inadvertently commit insider trading?
Exactly.
So the firms are being forced to build these massive compliance architectures just to monitor their own AI. The text notes that formal policies for data privacy, model bias, and AI usage are being institutionalized across the board.
You have to.
The AI has to literally show its work. But wait to solve these incredibly dense optimization tasks, evaluating thousands of tokenized assets, running continuous time math, processing satellite images, A and D simultaneously generate the massive compliance reports required to explain every micro decision.
It's a lot.
Standard computing power is going to hit a brick wall.
It already is. And that opens the door to the absolute frontier of 2026 trading tech. This is where we move beyond standard silicon chips.
Okay, the research dives into two specific emerging technologies here, agentic AI and quantum models. It notes that agentic AI is automating network slice optimization and fraud detection, which drastically reduces something called MTTR.
Right?
It also forecasts the first commercial applications of hybrid quantum classical models for complex optimization tasks like derivatives pricing. Now, I have to push back here.
Go for it.
Let's unpack these buzzwords. Let's start with agentic AI and this network slice optimization concept. Are we talking about the AI partitioning cloud computing power on the fly so the trading algorithms don't crash during a massive market surge?
You've hit it exactly.
Oh.
Let's distinguish regular AI from agentic AI real quick.
Okay.
The AI most people interact with requires a prompt. You ask a chatbot a question, it gives you an answer. It's passive. Agentic AI acts autonomously to achieve a broader goal. If there's a massive surge in market volatility, say, a central bank unexpectedly drops interest rates, the trading algorithms need massive amounts of computing power instantly.
Yeah.
And agentic AI doesn't wait for an IT guy to authorize more server space. It dynamically partitions and optimizes the network slice in real time to ensure the trading bots never experience a single millisecond of lag.
And it does the same thing for fraud.
Exactly. If it detects a complex anomaly in the tokenized plumbing, it acts instantly to quarantine the threat. That is why the research says it drastically reduces the mean time to resolution, or MTTR.
Okay.
The problem is resolved by an autonomous agent before a human even gets the alert on their phone.
Okay, I get agentic AI. That makes sense. But introducing quantum computing feels like overkill. If we already have supercomputers processing continuous time and massive data sets, why does a trading desk need to mess with quantum mechanics? What is the actual bottleneck they are hitting?
It really comes down to the sheer volume of possibilities. Think of a traditional supercomputer trying to find the best route out of a massive maze.
Okay.
It runs down every single path one by one, hitting dead ends, backing up, and trying again until it finds the exit. It is incredibly fast, but it is fundamentally linear. It processes in ones and zeros.
Right, line by line.
Now, in finance, imagine trying to perfectly balance a portfolio containing thousands of tokenized real-world assets. Each asset is reacting to real-time geopolitical NLP data, supply chain satellite imagery, and the continuous limit order book momentum we discussed earlier.
It's just too much.
The variables are shifting every microsecond. A traditional computer testing every possible combination of those variables to find the perfect trade would quite literally take years to run the math.
So how does the quantum model solve that?
A hybrid quantum classical model floods the entire maze with water all at once.
Oh, wow.
Because of quantum superposition, it can process multiple states simultaneously. It experiences every single path through the maze at the exact same time. When it comes to things like derivatives pricing, where the value of a contract is based on wildly complex future probabilities,
Right.
quantum models find the absolute optimal trading strategy hidden in a mountain of possibilities in a fraction of a second. You don't have time to test every path. You need the water.
That is an incredible visual. It really drives home the reality of this arms race.
Right.
So let's take a breath and look at the journey we've taken through this research today for you, the listener.
It's been a ride.
We started with a system based on human intuition and fixed rules. We've seen how that is being entirely replaced by an adaptive core engine. We explored how this AI uses satellite images and translated local news to see the physical world long before human analysts do. We untangled the intense math, the spider webs of graph neural networks, and the continuous flowing rivers of neural ODEs. We saw how this relentless speed is forcing the market to tokenize assets and run 24/7 on stablecoin plumbing, all while regulators frantically try to force these black boxes to explain themselves.
Which they are struggling to do.
Exactly. And finally, we've peeked into a future where autonomous agents manage server loads in real time and quantum models just flood the maze of market possibilities.
It is a profound structural rewiring of global finance. But, considering everything we've synthesized from these sources today, there is one crucial implication we haven't touched on. And it's something I think you, the listener, really need to sit with.
Okay, let's hear it.
The forecast makes it very clear. 90% of private fund managers will be relying on this adaptive self-learning AI. We are looking at an era of 247 tokenized markets managed by autonomous agents executing trades based on quantum optimization,
Right.
which means we are rapidly approaching a reality where AI is mostly just trading against other AI.
Oh, the humans are entirely out of the loop of execution.
Completely. And if this decision intelligence removes human emotion, human hesitation, and human error from the execution entirely,
Yeah.
what will actually drive the market crashes or booms of the future? Historically, markets are driven by human psychology,
Yeah.
right? Fear and greed.
Right. Panic selling and FOMO.
Exactly. But in 2026 and beyond, will our markets be driven by algorithmic hallucinations? Are we building a financial system where machines react to the math of other machines in ways we can no longer comprehend or control?
Man, that is a chilling thought to leave on. The blueprint hasn't just been redrawn. The machines are drawing it themselves. In real time, in a language we are only just beginning to translate. Thank you so much for joining us on this deep dive into the 2026 financial landscape. Keep your eyes on the parking lots, and we'll see you next time.